Good day, traders. How are we doing today? I want to thank you especially for the subscription on my channel. Not only the subscription, I want to thank you for the share and the comments. All right, the share, the comment, the likes, and so on and so forth. I'm so proud of you guys, all the subscribers and the viewers. I'm so proud of you. Increasingly, I'm seeing that there's so much love on this channel. I can see from the analytics that a lot more people are very keen to watching my content. It's helped me to definitely help me to improve more on the kind of content I bring to you. Have to improve the quality. Have to bring a much more better content that will improve your overall trading, adventure. All right. So today I want to discuss a very, very important topic, with you. Because of the likes, because of the share, because of the subscription, because of the comments, I'm so happy, that I thought within myself that I must bring a topic that will change the way you trade. I must bring a topic that will change the way you trade, because I know that many people have not smelled success in this business. Many people have always found it difficult to trade in a way that will bring them profit. I can tell you, many people have never withdrawn money. I've never withdrawn money in this business. So the question is, what are they doing? What are they doing that is wrong, that they must correct? Because everybody was at a point in time in that category where you try, you make money, you lose it, you make money, you lose it. It's always like that. But you must ask yourself at a point, what have you been doing wrongly that you must correct in order for you to start making money? So the curve is simple. When you start, let's say you start trading forex here. You see, initially, the curve will be going down. It will be going down. It will be going down. Later, it will be going like this. You make money up, you lose it. 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 At the time, it will go up. You lose it small. It goes up, you lose it small. It goes up, you lose it small. It goes up, you lose it small. This is how, this is the true, chart of from amateur trader to, with little experience and to an experienced or professional trader. A professional trader will look like this. We have his curve, equity curve looking like this. All right. But it does not start to look like this from day one. All right. It will get to a stage after falling every time, falling equity curve. It will get to a time it will stabilize and consolidate this way. Okay. And then sooner or later, when there's improvement in knowledge, there is improvement, in terms of the understanding of the market and its structure. There's improvement in terms of the fundamental analysis. There is change of orientation and perspective about the market, and at this point in time, we are beginning to see the market, as your friend. You are beginning to see the market as, not the one that you are smarter than. But of course, you see the market as being smarter than you, but you must use trick to follow it in order for you to be able to take your own. At that point in time, you are going to see your equity curve keeps on rising this way. So without much story, I'm going to tell you 10 things you must do to achieve success in forex trading. I'm going to tell you, just sit back, watch this video from the start to finish. I'll be very sorry, guys, if this video is longer than 1 hour, because I have spotted a lot of problems that is associated with an average trader that is bringing them all the time, that's making them not to be able to withdraw from their broker all the time, and have, haven't trained more than 1,000 to about 1,000 300 students, all right? Having interacted with more than 3,000 students in forex market, I know the problem that beginners forex trader and even intermediate forex trader have. Even in some cases, in people that call themselves guru, they fall victim of some of these problems. That is why this video is not made for a starter. It's not made for beginner. You know, it's not made for only intermediate students. It's even made for more advanced students, because there are many things that they think they are doing rightly that, of course, they are not doing rightly at all. So I'm going to start with number one thing you must do to succeed in this business. Start analysis from fundamental. Okay, start analysis from fundamental, guys. Start your analysis from fundamental. When I say start analysis from fundamental, for instance, fundamental will be able to give you the long-term trend of the market. For instance, this is CAD JPY. We know right now that Canadian dollar has a positive interest rate of 1%, while the Japanese yen has interest rate of -1%. Okay, you can see the wide difference between Canadian dollar and Japanese yen. Okay, so for quite some times now, I told my guys in the group that even though if you look at weekly time frame this way, if you look at weekly time frame, guys, you see that Japanese CAD JPY has reached its reversal level, because this corrective structure, after this push down, this corrective structure is over, guys. We need to begin to see a move down. Even though it's like this, guys, you know, we should be expecting sell. But right now, because of the interest rate differential between Canadian dollar and Japanese yen, making CAD to be very strong right now. CAD is very strong because of interest rate of 1%. All right, and JPY is very weak with interest rate of -1%. So if that is the case, because of that differential, we should expect that CAD JPY should go up. CAD JPY should be bullish. Do you understand now? CAD JPY should be bullish, even though technical analysis is telling us that it should be bearish. So if you follow technical analysis, you just keep selling at this level. But because you must have knowledge of fundamental analysis, with that knowledge, you will say that, okay, even though technical analysis is telling us bearish, fundamental analysis is telling us the bearishness is not ready. The bearish structure is not ready. Do you understand now? So on that basis, right now, you have to go to, let's say, 4 hours to go and see the structure that you have. So if you see it this way, you know, you can see truly that the structure is not ready. If you look at it from a 4 hours perspective, can you see you have this, you have this, you have this. All right, you have the three-way structure. So you can have a three-way structure here, this and this in the middle, before you have this one down. You can you see that it's staying too long over here. It's not ready to fall right now. Why is it not ready to fall? Even though technical analysis is telling us to fall, fundamental analysis is telling us that CAD is very strong compared to JPY because of the interest rate differential. So it's going to be very difficult right now for CAD to just fall straight against the JPY. So in as much as it has reached its termination point for it to proceed to the downside, the fundamental analysis that we have done on CAD JPY is telling us that it is not ready for the fall. Therefore, we can still be catching some pips over here, you know, or if you don't want to be greedy, guys, after this formation of three-wave structure, and this one has formed impulse, and this one has formed three-wave structure, okay, you are expecting this one to complete the structure. So that this will be W, this one X. So since you are expecting a bearish nature in technical analysis, you can wait, let this complete. When this complete, you can take this sell to the downside. Can you see can take it to the downside to complete the structure. So that is how you are going to replicate, you know, the analysis on any pair you want to take, guys. You don't just take a pair and begin to trade it anyhow. You must first identify the fundamental, you know, factor that will drive the market either to the upside or to the downside. If you have found a fundamental factor that will drive it to the upside, you will now come to technical and be looking at technical factor, technical, analysis that will ensure that buy. It's simple. That was why when these guys, when this pair made this three-wave structure to the downside, I did tell them in my group that do not look at this fall. It's just a complete structure. CAD JPY is still bullish, even though at higher time frame, we should expect some bearish move. So this guy must go up like this. All right. So that's how you do that. Another point, guys, point number 2 that you must look at, in order to succeed. Take note of that. You must start to look for what? Technical alliance. That's what they call technical alliance, guy. You must look for technical alliance. For instance, guys, look at this pair. Let's use CAD JPY. For instance, because fundamental analysis is giving us a buy, because we have checked that interest rate differential, okay, and we are getting a buy, at least for a short time. It's not a long-term trend, it's a short-term trend. So what we are going to be doing is to look for a buy setup, guys. And how do you do that? If you come to this place, you have seen these 3 waves here, guys. All right, you have seen another impulsive leg here. So you now see 3-wave structure in the middle. So you are expecting this to complete the structure. So you can see that I'm cutting the waves based on their sizes. I'm not just cutting it anyhow. So this one will be W. These 3 waves here will be X. And can you see that these 3 waves here that is making X, 1, 1, 2, and 3. All right. This 3 wave that is making X is equivalent to this 1, 2, and 3. So the size and the proportion of the waves that I'm cutting here is very important, guys. Okay, it must be of the same proportion. And then after this X, you will now expect this 1, 2, 3. So you're looking for technical alliance. If at this present moment you expect CAD to be strong or to be stronger than JPY, then as soon as this impulse finishes for me, this impulse here, we have to take the fib of that impulse. Okay, and you know the rule. The rule is that if you take a fib of an impulse and the correction is giving you a zigzag corrective structure, that zigzag corrective structure is not going to end at 0.5% retracement. It's not going to end at 0.618. It's going to end at 78% retracement. All right. You can go back to my, to my Elliott wave theory course. Okay. You see Elliott wave theory course part corrective structure. That will be part. No, even motive wave. All right. Motive wave. When we were discussing impulse, I told you very clearly there that zigzag corrective structure will not end at 61.8. It's going to end very deep at 78% or 79% retracement. Can you see example here? Boom. Look at the zigzag structure, A, B, and C. What makes this one to be zigzag? This correction is up to 50% of this impulse. Okay, and then this length here, this is A, this is B, this is C. This length here is equal to this length here. And this length here is 78 or 79% retracement of this impulse. So by virtue of that, it has become a zigzag corrective structure. So when you now take a buy here, you can see your buy now is in line with the fundamental analysis that CAD is stronger than JPY. So if you take a buy here, it's going to be a success. Can you see? Simple. All right. That is point number 2. Point number 2, irrespective of the technical analysis method you are using. First, determine the fundamental. Second, determine the technical alliance. Make sure the technical analysis is in line with the fundamental that you are using. Number 3, never buy from supply and never sell from demand. Wait, wait for discounts to be given to you in the case of buy, and wait for the price to come to premium in the case of a sell. Can you see now? Never buy at supply and never sell at what? At demand. Never buy at supply and never sell at demand. If you want to buy, allow discount to come to you, and if you want to sell, let price comes back to premium price. This is, rule number 3, guys, that you must follow in order to succeed in trading. Let me explain, guys. Let me explain. For instance, if you look at this market right now, after the formation of this 3-wave structure to the downside, when this one falls, okay, this area here, guys, is a supply area. Can you see this candle that moved down from here to here? This is a supply level, guys. This box is a supply level. You cannot buy. The law says that, the rule says that, do not buy at supply, because this market has moved off. It has gone. Don't buy at supply. This is supply. Don't buy there. And then don't sell at demand. This is demand, guys. Do not sell here because you are seeing this big candle. Don't sell here. Do not sell here. And then I also said that when you want to buy, allow the impulse to give you what? Discount. Where is the discount, guys? Look at the price here. When the price was here, 108.88. We are saying that do not buy at this 108.88. Allow the market to give you discount. Where is the discount? 1, 2, and 3. The discount is here. What is the price here? 98.44. Look at where you will have bought, 100.88. Now that you have allowed discount by way of pullback here, you are now buying the same market at 98.44. You are buying at a cheaper price. So if you must buy, allow a discount. This is an impulse, a fast market. This is a discount. The discount has come back to this 5th level. 5th level will give you the level of retracement of that impulse, and that is the level of discount that the market is giving to you. All right. So if you must buy, do not buy on the impulse. Let the impulse give you a discount. And then if you must sell, all right, like this one, after this market make a move like this, you see this impulse. So this correction must break down. Okay. So if you must sell, do not sell at this impulse. Don't say this candle is coming down very big. Kai, very powerful candle. I'm going to sell. I'm going to make money on this candle. It's a lie. You can't make any money, because as soon as you jump in, guy, the market will retrace against you. So by this market coming back to this area, this is where it started to sell. Look at where you have waited patiently. It has come back to give you a premium price here. This is a retail price. If you take a fib of this impulsive leg, you will see that this has come to exactly 50 to 61.8. This is where you are going to sell. This is what is called a premium price. So if you must buy, you must wait for discount. If you must sell, you must wait for premium price. Rule number 4, guys, that you must follow in order to achieve success in trading is that don't trade at fair value level. Don't trade at fair value. What is fair value, guys? The fair value, you can call it consolidation. For instance, and call it consolidation. It's an equilibrium price. Can you see this level, guys? This level, the whole of this level is an equilibrium price. There's no need for you to take this buy, take this sell, take this buy, take this sell. You don't do that. Once you identify that a zone, a boundary has been created, a zone has been created where market is going up and down, you have no business in that market. So what you have to do is to wait patiently. Look at it. Let's say in this boundary now, market is doing like this. You don't have to be doing all this buy, sell, buy, sell. Don't let anybody deceive you, guys, that you can buy within this. You are wasting your time. It gives you a lot of headache. You can make money occasionally, guys, but you have too much headache trading that kind of market. So what you want to look at is to look for where this market will break out to. Remember, you already have an impulse here. So you are expecting that this market will break down to the upside. Allow this fair value zone to be taken. When it's broken down here, you can see that this is equal to this. So with this now, you have a 3-wave structure. Then you can now proceed to the upside. That's what happened here. You see a move down, you see fair value zone, you see fair value level. So as soon as this breakdown, it has taken liquidity from this demand zone. Can you see? It has taken liquidity. And what do you see? Rejection upside. Do you understand? But selling and buying inside this box is not good, guys. It does not help your trading psychology. You have to learn to take a trade where as you are taking the trade, it's taking you straight to profit. You know, it's taking you straight to profit and don't have to start disturbing you up and down, carry you up, taking you down, taking you up, taking you down. It's a very bad way to trade. So don't trade at fair value. Do not join trading at impulsive phase. Wait for correction to appear. Do not join trading at impulsive phase. You must wait for correction to appear. For instance, look at this market. This is an impulse. Can you see it's very sharp? This sharp market, you are not expected to buy it at any point at all. You are not expected to buy it at any point at all. So somebody will now ask me, Nat, why? The market is very bullish and is buying very well. Why do you say we should not buy it? Yes. The reason why I say you should not buy it is that this market that is buying very well, guys, cannot go up forever. It cannot go up forever. It must come back according to the rule. No market, goes up like that. That does not come back according to the rule. Look at it, come down. It has to go back to the upside according to the rule. To take liquidity, jump down, or drop down. Can you see supply zone? It's coming down to that place. Where does it do? Drop down. This is a three-wave structure. After this impulse, this is three-wave structure, discount. You see, boom, to the upside. Don't join the impulse. No, don't join the impulse. For instance, let me show you one example before I go to the next point, guy. Let me show you an example. If you have an impulse here, you have correction here, you have an impulse here. What we are saying here, guys, is that you are not supposed to trade this one. You are not supposed to trade it. Know that this one cannot go up forever. It must step down. It must come down. It must correct this impulse. It must correct it to about 50 to 61.8. As soon as you get to that level, you can now take your trade to the upside. So do not join an impulse if that impulse is not a continuation. If that impulse is just starting, you don't join it. This is the kind of impulse you are going to be trading. I'm going to show you guys. These are the kind of impulse. You see impulse, don't take this one. After this correction, this is the next impulse that you are supposed to take. For a sell trade, after you see this impulse, you see this correction, this is your trade, guys. This is your trade. This one here is not your trade. I mean this one, let me show you guys. This one is not your trade. This is not your trade. This is the first impulse. Allow this correction to happen. After that, this is your trade to the downside. And as soon as you break this low, if you are a day trader, prepare to close, because sooner or later you have this pullback already again, then push down to the downside. Do not join on impulse at all. Okay? That is the rule 5 you must follow, guys, in order to make money in this business. Then number 6, learn different types of correction and how to trade them. Is very critical, guys, because of course you know that 80% of the time market goes correctively, guys. 80% of the time market goes correctively. It is only 20% of the time that market goes trending. All right. So if that is the case, guys, you have to learn different types of corrective structure. How do I know? How do I know, guys, that at this level I have to get in for a buy? How do I know? Because I've seen this as as an impulse. Okay. And when I saw this as a corrective structure, I know this is a zigzag. Okay. This is a zigzag. And even it's a triangle, guys. Okay, it's a triangle. You guys should know how to recognize a triangle. It's a triangle. If you take it to smaller time frame, it will be clearer for you guys. So look at it. Let me show you the 5-wave structure in the triangle. 1, 2, 3, 4, 5. Okay, with wave 5 itself forming another structure. Don't just leave that one. We are not dealing with triangle. Just to show you, this is a triangle and you have a move down. Okay, so inside this zigzag, you have a triangle inside. This is wave A, the triangle is wave B, and this is wave C. Can you see? So I have recognized this as a corrective structure here. Therefore, this move to the upside must come. This move to the upside must come. So you must know how to spot a corrective structure. It's very, very important that you know how to spot a corrective structure. Let's spot another corrective structure. Let's spot another corrective structure. Okay, let's spot another corrective structure. Aha, look at this one now. For instance, you have this market, make a push to the upside. I say, do not buy this one. Wait for this one to appear. This is a regular flat corrective structure or expanding flat corrective structure. And after that, this is your trade. Do not trade this one because you don't even know the extent to which it will push up. Okay, but as soon as this corrective structure is done, you cannot take this trade to the upside. Do you understand now? So you must learn different types of corrective structure. So if you don't know different types of corrective structure, you can go back to my video on corrective structure. You can go back to it, learn zigzag corrective structure, flat corrective structure, different types of triangle, and different type of combination corrective structure. Just search Nathaniel Tunde. Of course, you are in the channel. All right. For you to be in this channel, you already know the channel name. Search it. You know, go back to Elliott Wave Theory course. You are going to see it on the playlist under education. So there you can watch a lot of video as far as corrective structure is concerned. But guys, you need the knowledge of corrective structure to be able to trade properly. So learn different types of them. Number seven, guys, place your stop loss at the right level. Place your stop loss at the right level. This is one of the problems of many people. Okay, when they analyze the market plays out the way they analyze it. But the question is that they are trying to increase their loss side, and they are trying to increase their loss side so that their potential gain will increase. Okay, so because of that, they don't remember to position their stop loss in the right level. And as a result, they fail woefully. Let me give you an instance. You see this market now. Let me show you. It has a push this way. It's giving me a three-wave structure. This is a three-wave structure, guys. And this three-wave structure is a running flat. And I've seen that this is a running flat. Let's confirm with the indicator. Okay, let's confirm with this. See this level? You see this level? You see this level here on stochastic RSI? You see it here, the same level, lower low. Okay, you see on the indicator here, on the price here, higher low. Can you see that there is the divergence? This one is giving us a lower low here. This one is giving us a higher low here. So this is what is called bullish hidden divergence. And that is what I use in confirming the completion of a running flat corrective structure. Okay, what it means is that even though this one is higher than this one, on the indicator is telling us that it's lower, that is a better price to buy. That is even better than this one. That this place is a better price to buy than this place. Though this price is cheaper. Okay, but this indicator is telling me that even though this price is cheaper, it's more expensive here. On the indicator, it is this one that is cheaper for us. That means that it's this one that will achieve a greater push to the upside. And look at it. Look at how much this one push to the upside. Let me show you. I'm going to show you real quick, guys. Look at how much this guy pulled to the upside, and let's see how much this one pulled to the upside. Can you see the difference is clear? Very, very clear. So this is one of the things you must know, guys, to achieve success. Then the question is that where should you put a stop loss? Okay, where should you put your stop loss? In as much as you have identified this, you put your stop loss below this particular level. Put your stop loss below this level. Why? In case this one comes down to form a different type of flat so that it will not hit you. That's for this one. Then, if you are having a zigzag corrective structure, where should you put your stop loss? Look at it. Look at it, guys. Look at it, guys. After this move, you have 1, 2, and 3. So since this one has gotten to 78% retracement, all you just need to do is to put your stop loss below the impulse, below this impulse. Then pick your trade from here, and you are on your way to the upside. Do you understand now? It's as simple as that, guys. Put your stop loss far below. At least when you calculate it, it should be about 80 pips or 70 pips. Okay. Most of the time, when we position our stop loss rightly with 1 hour to 4 hours time frame, the stop loss, my stop loss is usually about 50 pips. All right, about 50 pips. If my stop loss is getting bigger than 50 pips, I consider not to take the trade, except the pip value is very low, like you have in Euro New Zealand, you have in AUD, AUD New Zealand, AUD, Euro AUD rather. All right, so that is number 8, guys. Another thing, before I go to number 9, let me still give you one example of where to position your stop loss. If you have, I told you, in the case of flat, zigzag, you can put your stop loss below here. In the case of, excuse me, in the case of flat, where you have 1, 2, and 3, you can just place yours. I normally place my stop loss at 78% retracement. In the case of zigzag, I place my stop loss below the impulse. And in the case of triangle, guys, 1, 2, 3, 4, 5. Okay. In the case of triangle, it's a triangle. Once I identify it, guys, you know, I'm expecting this move to the upside here. But most of the time, triangle like to do what is called overshoot. This with A, with B, with C, with D, with E. This with E like to form an overshoot like this. So when you get the overshoot like this, what you just do is that you wait patiently. As soon as the overshoot is finished, take liquidity from the demand here, you now buy to the upside and put the stop loss below this impulse because you are entering here. What of a case where somebody can just come in and say, Nat, what of a case where there's no overshoot of this E? Okay, this E does not do overshoot. What do? No problem. You cannot make it to do overshoot at all means. You can either wait, let this market break this level, correct, and then you join the buy, or you can take the market on the completion of with E as a risk entry. You position yourself at 78% retracement for stop loss, guys. That is number 7, guys. Placing stop loss at the right places. Is there any other structure that we have not learned how to place the stop loss? I think this one is okay. All right. So, guys, I want to go to rule 8. Know the right session to trade and choose the right pair to trade. One of the problems of many traders is that they tend to go and look for a pair that is not moving at all, a pair that is consolidating in one place for months. Those are the pair they consider for trading. For instance, AUD, NZD. This pair can you see, guys? I'm gonna clean up. Can you see, guys? Can you see the level of consolidation of this market, what are you going to make inside this consolidation? Look at it. He likes to consolidate. He likes to consolidate so much. What are you going to take from there? So you must be able to tell yourself the right pair you must trade in order to succeed. So why are you leaving GBP, JPY, GJ? Why are you using GU? Why are you leaving GU? Why are you leaving EU? Why are you leaving UCAD? Why are you leaving UJ? Why are you leaving New Zealand dollar? No, this appears. Why are you leaving Euro JPY? Euro JPY. These appear that are moving in the market. This appear you're supposed to stick with, guys. So, and you must be able to do your research to know the one that move more in Asian session, the one that moves in the London session, and the one that move very fast in the New York session. You must be able to identify some of these pairs, isolate them, and do not trade the one that is supposed to move very fast in New York. Now start to trade it in the Asian session that is in consolidation. It's not going to work that way. It's not going to work that way. In fact, I encourage every person following me and my subscriber not to trade in the night. Don't trade in the Asian session. You have no business trading in the Asian session. It's too slow and sluggish because most of the participants in the market at that moment are sleeping. They are not in the office. Okay, so you don't expect business to flow as usual. So know the right pair to take. And I have an example of people who start up trading and start trading with crypto. I shouted, I screamed. Only the commission they will charge you will make you lose. Why are you starting up with crypto? For what? So we must be careful in that area in order to succeed in this business. Let's go to rule number 9. You must plan your setup. If it plays out, then you can take it. But if it does not play out, you leave it. You have to plan your setup. For instance, I'm going to show you right now real quick, guys, on Telegram, the different setup that we have done there. See, on Telegram, where's Telegram? Okay, let's go to, let it just load. You see different setup that we have done on Telegram. Just let it load, guys, so that you see how it works. Okay, you see, so this is our channel, guys. You see the setups, you see all of them. These are setup that see, guys, see, these are setup that we have put in place. So what is this rule talking about now? The rule is saying that you must plan your setup. This particular point is addressing a lot of traders, because what did they do? They did not do any research. They did not do any plan. They did not do any program. They just come up to the chart at London session. They just look at it, buy, sell, buy, sell, buy, sell. It does not work like that. Any pair, any instrument you did not plan, please do not trade it, even if you see a setup on it. Can you see? These are my interested pair to trade. This week we are going to enter, and I have done all the setup there. I will just be patiently waiting. All right, on Monday, Tuesday, because I'm doing this recording right now on Sunday. On Monday, on Tuesday, I want to follow up this pair, and I want to see them. Following the plan that I have outlined for them. I've done a detailed research on these pairs. I've done my fundamental analysis. I've gotten my direction. I have prepared the technical analysis down in order to reflect the direction of the fundamental. And as soon as this technical setup plays out the way I have outlined it way back before it's the setup is done, if it plays out like that, with confidence, I will take it. It then means that it's showing me that I know what the market is doing. But if you have no such plan like this, you have no such setup like this, you see, you don't have setup like this. You just wake up in the morning, just come up to your chart, and you are just clicking buy, sell. Look at this one, for instance. We have known here that this is a triangle here. We want it to break up, catch liquidity here, we want to sell. This is a plan, guys, based on your technical analysis. You must be able to have this plan in place. And if this plan is now working out based on how you have outlined it, you know that you are in the right path. And then you can take the trade. Do not take a trade that you have not planned. Do not take a trade that you have not planned. Now, let's go back to our chart, guys. Let's continue. So that is point number 9, guys. Must plan your setup. If it plays out, guys, you take it. If it does not play out, guys, ignore it and look for another one. Finally, guys, last but not the least, is not the least, guy, is even one of the most important of all the 10 rules, guys. The 10th rule is finally apply risk method that stipulates total percentage you can lose daily. This particular point, guy, is going to save you from blowing your account. This particular point is going to save you from blowing your account. If, for instance, you've gotten an account balance of, let's say, you've got an account balance of $1,000, guys, $1,000. You have to decide within yourself. Either you say, how much are you willing to expose to the market in a day? Or you say, that is how much in dollar out of this money you are exposed to, you are expected to expose, or you are willing to expose to the market daily. Or what is the percentage you are willing to risk daily? Okay, if you go in terms of dollar, if that is the one that resonates more with you, you can decide to say, oh, every day you want to be exposing $50 to the market. Even if you are losing all the $50, it will take you 20 trading days for you to lose your money, for you to lose your account. Are you okay now? If you now decide to say in terms of percentage, you are ready to expose 5% of your account to the market daily. 5% of $1,000 will still boil down to what? $50. Can you see? $50. That's what you are ready. And if you lose 5% in a day, that's the end for that day. That is why you must not put all the 5% on a single trade. You can just look for 2 trades. You can just say 2% here, then maybe 3% here. So the first trade you are taking, you risk 2% of your account. And if 2% of your account is ended as a loss, glory be to God. Go to the next setup based on what you have planned before, and the setup is, the market is playing according to your plan. Go to the next one. If you now risk 3% of that second trade. If that 3% of the second trade, you now trade it, you risk 3%, you now get 10%, for instance. 10%. What happened? Your equity has increased from $100 to what? To $1,100. Okay. No, you have lost 2% before, and 2% is $20. You have lost $20 before. $20. So your money has remained $998. Okay, from your first trade, you lost it. The second trade, you risk 3%, you gain 10%. So 10% of $100 is what? $100. 10% of $1,000 is $100. So if you add this $100 to 98, your money is now $1,098. Can you see? Why is it growing very well like that? Because when you lost, you have kept your loss very small, and when you win, your win is very big. Do you understand now? So if you exhaust 5%, assuming this 3% end up in a loss, it means that you got 0% that day. You made no gain that day. Instead, you made a loss of $30 for 3% and $20 for 2%. 30 plus 20 equal to what? Equal to $50. So you have lost $50 for that day. But anyone you win, guys, is going to push you up. That is how you grow your account. So that is the trick. So these are the 10 tricks you must apply. These are the 10 rules, guys, you must apply in order for you to smell success in trading financial market. Let us recap again, guys. Let's recap again. I've said number one, start with fundamental analysis to get the long term, the short term, and the medium term market direction. I said number two, you must do technical analysis in order for your technical analysis to be in alliance with the fundamental analysis that you have determined earlier. Number three, never buy from supply and never sell from demand. Wait for discount to come to you from the buy and wait for price to go to the premium price at and when you want to sell. Number four, don't trade at fair value, guys. Fair value is nothing but equilibrium price where demand and supply has agreed. You know, they have agreed on that price range. It's a fair value zone. Do not trade there. And unfortunately, that's where retail traders operate. Do not trade there, guys. Do not trade there. Then number five, do not join trading at impulsive phase. Wait for correction to appear. Number six, learn different types of correction and know how to trade them, guys. Number seven, place your stop loss at the right level. Number eight, know the right session to trade and choose the right pairs to trade, guys. Choose the right instrument to trade. Number nine, plan your setup. If it plays out, guys, according to plan, take it. If it does not play out according to plan, leave it and look for another one. Do not jump into trade anyhow. Finally, number 10, guys, finally, apply risk method that stipulate total percentage loss you can part with in a day of trade. So that is it, guys. I hope this you have learned a lot from this, guys. Okay. So if you have not subscribed to my channel, of course, you know my name, Nathaniel Tunde. I'm very passionate to bring you everything that will make you to achieve success in this business. Just stick around, follow me. I will show you. I teach market raw. I am not a fake guru, you know, on YouTube. I teach you raw as it is happening. Just follow what I tell you. And in 9 out of 10 times, I'm correct in this market. I don't want to say 10 out of 10. Because if I say 10 out of 10, guys, it means I'm saying I'm perfect. And it is only God that is perfect. I'm not perfect. That is why I say 8, 9 out of 10 times, I must be right in my market direction. Consecutively for 3 to 4 years now, I have been very consistent in my market direction. All thanks to Elliott wave theory, all right, and some other techniques that I use in the market. So if you enjoy what I do, if you enjoy the content that I pull out for you on YouTube, just make sure you subscribe to this channel. Just click it, subscribe. Share it to your friend, let them subscribe. Those ones that are doubting Forex and financial market, let them subscribe to my channel. I'm making it is a household of knowledge when it comes to Forex trading and financial market, you know, education or financial education in general. Subscribe the channel, share the videos, you know, comment there, let me know your view. If you are not comfortable with what I'm saying, just let me know your view. If you like it, let me know your view. If there is any video or any assistance you need from me in terms of any topic you are confused about, just let me know, guys. I'm going to produce the video and help you. Somebody said I needed to help them to do videos or training on Elliott wave theory because he knows it's my areas of expertise. I did the course, 5 parts for Elliott wave theory. I did it. You can also write a comment and say, I don't understand so. Can you help me prepare a course or a video for that? I would gladly do that for you. Okay, so guys, share, subscribe, you know, and press notification bell so that you can receive all notification from my video. Thanks for watching. See you in next video. Peace.